Hey guys, I think we're close to a quorum. It's 11:04. I'm going to give it until it flips to 11:05, and then I'm going to start. Just so everybody knows, in full and fair disclosure, I am recording the call so that we have it for future reference for advisors that couldn't join. And secondly, I am going to mute all of your lines during the prepared part of the presentation, but we have set aside time at the end for a Q&A, and I'd really love it if you have questions to ask the group. We've got some great people on the line to help answer them. But during the prepared part, I'm just going to put us on mute so that we have a quiet call for the presentation. So according to my clock,
conference muted.
According to my clock, it's 11:05. So I'm going to kick this off and welcome everybody to Foundational Retirement Solutions GRP Advisor Alliance Collective Investment Trust brand, if you will. We are really pleased to have this call and to be joined by some amazing folks from BlackRock, and we'll they'll be taking us through a portion of the presentation in just a few minutes. But I wanted to take just a second and begin the process. Here are our guest speakers, folks. We have Amy Whitelaw, who's Managing Director, and she's the head of the Index Asset Allocation Team. And Amy, I apologize, I may mess this up. I know you went through this with me. I think you manage approximately $130 billion in LifePath Index and then $400 billion in other investments for BlackRock for a grand total of $530 billion, which is a tough number for me to wrap my head around. But welcome and thank you a ton for taking your time. We also have Sean Lewis from BlackRock. He's an investment strategy expert, and he will be talking to us about elements of the bond and fixed income component, as well as how and why we should think about leveraging the Foundational Retirement Solutions Target Date Fund. And lastly, we have Jeff Spiegel, who is my compatriot at BlackRock, who I work day in and day out with on creating the collectives that we've worked to bring to market here and that we're talking about today. So welcome to the three of them, and again, thanks to all of you for taking your time. I know this is it's a Friday morning and busy time of year, so thanks a ton. On moving forward, we're going to talk today about the Target Date Fund itself and Foundational Retirement Solutions. We're going to talk about why we should consider it. We're going to talk about the glide path that Amy and her team work on and how they deliver it and the advantages. And then finally, I'm going to follow up at the end with just a little bit of information, more tactical information on the Target Date Fund itself. And then we will have time for questions and answers. And I hope people avail themselves of the Q&A time. I think it's a great time to talk to some fabulous folks. So where are we? Foundational Retirement Solutions. What is it and why is it? GRP Advisor Alliance created a separate brand called Foundational Retirement Solutions to deliver our collective investment trusts under or in, depending on how you'd like to think about that. And our goal is to create an entire suite of collective investment trusts. We're not just doing one. We're not just doing a target date fund or just a total return, though those are the first two we're bringing to market. Foundational Retirement Solutions' goal is to create a suite that meets many of the needs in an average plan lineup. I'm not going to say all of the needs. That would be a little too bold, but many of the needs. We're looking at creating a series of CITs for index funds, individual mandates, which is really what the total return fund, we have a call on that next week. I hope you can all join that as well, where we talk about the total return fund, an individual mandate. We're looking at multi-DCIO sub-advised CITs, so multiple DCIOs within a single CIT, potentially targeted at an asset class or asset classes, things like large cap growth, large cap value, SMID, etc., but comprised of multiple DCIOs. We're also looking at target risk funds, which a lot of advisors have shown a lot of interest in, and creating the concept of risk-based portfolios that are similar to a target date fund, obviously, but focused on risk as opposed to explicitly age. And then we're also creating a target date series, which is what we're here to talk about today. So we're using our leadership position in the industry, which I think is incredibly strong right now, to drive these conversations and really partner with firms like BlackRock to create innovative solutions leveraging our scale. So if you think about this, Our goal is not a thing. Our goal is to create multiple options that fulfill different plan sponsor needs, different participant needs, while leveraging, as Bill was talking about earlier, the construct of a CIT, the expense structure of a CIT, to deliver a win-win-win for the advisor, for the plan sponsor, and also for the participant. We have a lot of scale in the marketplace right now, and it allows us, realistically speaking, if we look at the next slide, to leverage our group buying power. Approximately $82 billion on its way to 100, and if I ask Bill, on its way through to $200 billion. Use that group buying power, the size and scale, to drive and gather institutional pricing for the advisors in the system. One of the things that this allows us to really do is offer these products, these investment vehicles, to plans of all sizes. So historically, to do a CIT, to get a collective investment trust, you might have had to have $100 million to approach an investment provider, a DCIO, to look for mandate pricing or institutional pricing, true institutional pricing. In this way, by leveraging our group buying power and our scale, we can package these up, and we can create a collective investment trust that, once funded, we can use for any plan size. So we have a lot of smaller plans out there that may have more expensive target date funds. For example, as this slide points out, the industry average across all target date funds is 45 basis points, and we're able to offer an active target date fund, active fixed income component, and the equity side are indexed for 22 basis points, less than half of the industry average. So these are the kinds of things, and again, this is that innovation that we're looking for, and driving out that win-win-win where the participant actually is getting incredible value but still retaining incredible expertise and management of folks like Amy and her team. And that's part of the storyline that I think is very important for us all to sort of think about, and particularly when we're having conversations with our plan sponsors. As Bill mentioned earlier in the call, he was able to have the conversation with his largest client about how collectives work and how there is this just an evolution between formerly separate managed accounts, that's the way they used to invest, and that became mutual funds, which were actually created for retail investors, not explicitly the 401k world, and then collective investment trusts, which have been around for 75 years and were actually created for ERISA plans, but were always way up market, and now through these programs are coming down market and available to plans of all sizes. So I think we're at a really unique opportunity, and I'd just like to talk a little bit about the innovation that we believe this Target Date Fund offers. So we're partnering, Foundational Retirement Solutions and GRP Advisor Alliance are partnering with BlackRock, world-class glide path and index management, $130 billion in their Life Path series. They're utilized by 25 of the Fortune 100 firms, managing over $2 trillion in assets. So we've got a partner that has name recognition, they have the resources, they have the ability to do this and do this well. And then we're also partnering with Reliance Trust, one of the nation's largest trust companies, who actually creates the CIT and actually runs the CIT in partnership with us. And they've been around since 1975, providing independent financial advice. This triumvirate, if you will, the three groups listed on this page, have worked really hard over the last 9 months. This is not something that you just snap your fingers and comes about, to create something that we think is not only innovative, but has a storyline that will play very well in the marketplace. So as we get a little further into this conversation, and Amy and Sean start their portion, we're going to talk about a target date series that has, as I mentioned, the equity side is indexed, and we believe we can get beta that way, and we can perform very well. And then the fixed income portion is actually actively managed. And again, I'll remind you, that's actively managed and all in at 22 basis points. And as you guys all know, as a participant gets closer and closer to retirement, they have more and more fixed income just by the nature of asset allocation in their portfolio. And what that translates to is more active management as they get closer and closer to retirement of their assets. So we really think that we've got a great partnership. We're looking for diversification. We've got a great glide path. We've got a great strategy between our active and passive and the way that we've priced this for participants and plan sponsors to deliver something really, really quite clever in the marketplace. So with that, I'm going to turn it over to Sean and talk a little bit about why foundational target date. And Sean, let me know when you'd like me to advance a slide, because I guess I'm the guy with a mouse, and I will keep us moving through the presentation.
That sounds great. Thanks, Christopher. And I think you did a really nice job of teeing up the partnership, kind of what's unique about the strategy that's been created. Amy and I are both really excited to talk to everyone today about exactly what kind of thought process went behind this. Amy's going to dive into sort of the overall construction process and how the funds are put together. Very unique, very dynamic, which is necessary given today's kind of interesting and unique and dynamic markets. So if we're starting on slide 8, basic overview of how some people approach the target date fund construction process. If you look at the far left, in all active strategy, some people believe that alpha can be driven over long periods of time by seeking out opportunities across every single asset class. Obviously, that will come with some higher fees, and obviously that will come with the potential of underperformance in times where those inefficiencies cannot be taken advantage of. If you move one to the right, you have an all-passive approach, so all indexed. Many others believe that a strategic asset allocation is going to drive the majority of outcomes for participants. So they say, look, we're going to rely on that strategic allocation. We're going to take an indexed approach, and we're going to drive outcomes that are hopefully best for participants in that manner. And then a third possible approach is blending, meaning that you're taking both an index and an active approach to accessing every single asset class. There's many providers that have been very successful across all three of these. What we've done with the foundational target date series is really take a look at each individual asset class in isolation and say, where is the best opportunity to actually try to drive alpha and be into a professionally actively managed strategy to take advantage of market mispricings, inefficiencies that are seen, and then where is it most appropriate to remain indexed. As Christopher mentioned, with the foundational target date series, we do take a fully indexed approach on the equity side and an implementation actively on the fixed income side. If we flip over to slide 9, Christopher, excuse me, 10, I guess, on the presentation, we dive into a little bit about why going active in fixed income can make sense. If you really look at today's fixed income market, the interest rate environment that we live in is dynamic and challenging, and it's clear that we're at the conclusion of a 30-year bull market for bonds. And the conclusion of monetary easing, along with very complicated statements to the Fed, makes it difficult to go about indexing on fixed income. You can see from the chart on the left that about 50% of managers, active managers in fixed income, can beat the benchmark over long periods of time. It's a very promising figure, especially when you look at the successes across different asset classes. The backdrop that is being created with sort of this very challenging interest rate environment is one that a professionally managed active bond portfolio manager can take advantage of. And there's that evidence of active managers actually exceeding the benchmark over longer periods of time, which make us very comfortable and confident that this is the proper way to go, especially as Christopher mentioned. You have participants that are approaching retirement that are going to increase their bond exposures. Being active there can make a lot of sense, and we'll dive into that in just one moment. If we flip forward one more slide, please, we dive into the desire to remain indexed on the equity side. Now, of course, if you look at the chart on the right, it's going to show you that over long periods of time, across the entire landscape of equity indices, it's very difficult for a manager to beat the benchmark. You'll see that over long periods of time, about 80% actually underperform the benchmark from an active side component. This drives sort of a disenchantment with active equity managers, specifically when you're looking at a target date solution that's supposed to span 40 or 70-year investment time horizon. This inability to deliver outperformance is compounded by the fact that you're going to be paying higher fees. We did a study internally that showed that the 90% of returns for an actively managed index manager, actively managed equity manager, is actually going to be about 90%. So 90% of the returns of an active equity manager are driven by the index itself. So you're paying a high fee for sort of a veiled index manager that's having a lot of trouble beating the benchmark. In today's world, of course, there's a lot of lawsuits. Those lawsuits are increasing not only in volume but in overall value. So the need to justify incorporating active management needs to be very strong. You need to do the appropriate due diligence to make sure that you're going active in the right places. What we found is that on the equity side, that conversation is more difficult, and we've seen some very nice outcomes from just straight indexed equity strategies. Thus, in foundational target retirement, we have maintained a complete indexed approach when it comes to equities. If you flip to the next slide, what we're showing is the composition of the funds as you move through the life cycle. So we've got years to retirement on the left. So a person 45 years from retirement is going to maintain about 99% exposure to equities or growth assets. Those are going to be completely indexed when we're talking about the foundational target retirement series. As you move towards retirement, you'll see that the composition of active management increases as, of course, the allocations to bond exposures increases. What we like to say is that we're increasing this active exposure where it matters most, and that's for participants at and around retirement. If you think about the risks that are inherent in a bond portfolio, 90% of the risk a participant is achieving in their bond portfolio is driven by interest rates. I talked about the dynamic interest rate environment that we're currently existing in. The ability to have a professionally managed active manager that is able to address what's going on in the markets is actually prudent at this point in our minds. And so having the ability to say, look, we're going to efficiently access exposures on the equity side, and we're going to dynamically address exposures on the fixed income side is a very powerful statement. It's very meaningful for a participant at and around retirement that are highly risk averse. They need to protect their wealth. They need to be prepared for long retirement horizons, hopefully. So we believe that this is a very nice, unique, dynamic approach. And what Amy's going to do here in just a moment is talk about how we are incorporating these asset classes together and a little bit dive into the total return bond strategy that BlackRock manages on the fixed income side.
Okay. Great. Thank you, Sean. So now that I'm sure you're all convinced, because Sean did such a compelling job at convincing you that the blended strategy is the right way to go, makes my job easy. But let me just start by saying we are certainly thrilled to partner with you to fulfill your clients' needs. And as Christopher so elegantly stated, this is truly a great partnership. So let me just start by saying that we, as you've heard a little bit in some of the preview here, we have extensive amount of experience in designing target date funds. We are the longest tenured glide path manager in the industry. We started way back in 1993, over 20 years ago, designing the first target date fund ever. So we have experience in designing not only our standard glide path product, but also experience in designing customized versions of it, such as what we have here with the foundational target date fund strategy. But it's professionally managed. Certainly we have 25 of the Fortune 100 companies that trust us to manage their participants' money in a 401k plan, and we are bringing all of that to you inside of this product. We really wanted to focus today on three specific considerations that we had when designing this product, which is really one, first and foremost, about participants' behaviors. And we have extensive studies and explicitly in the design where we consider what are participants' behaviors that we see around saving and spending in retirement. The second key feature are some of the unique aspects of the product where we're customizing to your particular needs as advisors and clientele. And then the third will be more focused on what do all of those things translate into in terms of advantages or benefits for the participants. So let me go back and start with some of the key behaviors that we see from participants that we're being very mindful of here. One really critical thing to consider is loss aversion, or the overall psychological effect that people feel when markets decline and they start to see their assets eroded by the market moves. And we know that people feel losses twice as much as gains. There's a great study from some great academics, and they basically say that for retirees, they feel losses 5 times as much as gains. So we are trying to build over this long horizon, but being particularly mindful of what is the impact to retirees such that they stay in the product, they allow themselves to avail themselves of all of the engineering that's gone on through the accumulation years all the way through decumulation. We also know that as participants start to see volatility in the market, that they'll often do some bad things for themselves, which are to chase returns or to panic at the wrong point, to sell out, and then not enter back in to a product which can really, again, accumulate assets over time at the point in time where there's the market recovery. They'll come in too late. They won't come at all. So it's very critical that we provide smooth outcomes here, being mindful of the fact that otherwise there are some detrimental behaviors that people can take for themselves. Third key design element in terms of the participant behaviors, really around choice paralysis. So the design that you have with the foundational target date funds and then the other offerings really allows you to avail yourselves of some of this behavioral finance research that's been done around choice. And we don't want to overwhelm participants. Certainly as advisors, you will be there to guide them and to help direct them to the right choices. But we need to make sure that we set the stage with the right amount of choices to begin with. So really simply, you have one target date fund that incorporates, again, all of the great elements that we're going to talk about. So then in terms of what's unique to foundational in terms of the target date fund here, it's really designed to protect on the downside and to ensure that we're still getting sufficient upside capture. We are very intentional about this in the underpinnings of our philosophy that are well baked into whether it be LifePath or the foundational target date funds. If you look at our longer-term history and returns, what you'll find is that over a wide variety of market cycles, we're not necessarily going to outperform in the big market run-ups, but we are going to perform very well, if not significantly better than many of our competitors when there's a market shock. And again, that's very intentional by design, being mindful of all the behaviors that we've just touched on. With all of our products, second and very critical to the design here is really around diversification and focusing on broadly diversified asset classes. In particular, we've talked a bit about total return, and we think that is a very, very smart, wise choice in terms of how do you get the exposure to the broad fixed income market. And Barclays Agg is a terrific benchmark. We really think it does very much reflect the overall debt structure within the country. And because of the way that bonds are issued, it continually refreshes itself as new issuance comes to market. It obviously has a bit more of an overweight to treasuries, which is where some of the considerations around sensitivity to interest rates come into play. But that is a very important hedge for participants, for clients in this as they're nearing and in retirement. We don't want to give that up completely, but we want to be smart about how we're getting that hedge and where we're being mindful of interest rate sensitivity. So we'll talk a little bit more about the total return fund. Let me keep going, though, in terms of really incorporating participants' income and spending preferences. We've done an extensive study looking at academic research that looks at spending and income patterns for a very wide swath of Americans in this country, and it is fully representative of the patterns that's set up for people on average. That is explicitly incorporated again into our construction here to know where to take risk or where to have the amount of equities that we have and where to start reducing that over time. So that explicitly comes from that academic research. Lastly, moving on to the key advantages for participants, a little bit about this downside protection. We really do see that translate into limiting negative outcomes, creating a smoother ride for participants over time, and especially being mindful of what this means at retirement, near retirement, and through retirement. We want to manage the risk throughout everyone's glide path, throughout everyone's lifetime and through the glide path, which is that roll down of the asset allocation over time. We feel that it's very critical not only to look at returns over time, but to look at the volatility or risk over time, because if you just look at returns comparing potentially this strategy to other competitors, it doesn't tell you the full picture. It's a very two-dimensional view. In some way, risk, or directly risk, is indicative of the type of return movement that you'll see over time. And we want to take risk where appropriate, but really, again, minimize the volatility where we think it could most hurt participants psychologically and financially. Lastly, we are creating these improved outcomes by ensuring that we're enhancing the risk-adjusted spending profile. And we're doing this just by what I said, that we're not only looking at returns and, again, not trying to shoot the lights out here, but really being mindful of delivering those returns in the best risk-adjusted space, meaning that we are mindful of every unit of return per unit of risk that we're delivering to drive smooth, steady, good outcomes for your participants so that at the end of the day, they can retire with dignity and really not alter their lifestyle to what they've grown accustomed to in their whole working life at the point in time that they get to retirement and through retirement in very, very steady and hopefully consistent lifestyle that they've lived all along. So that's really more about the target date funds and some of what considerations we have in incorporating into them. At a high level, I've touched on many of these things, but if we go to the next slide, what we wanted to just share is the framework that really underlies this in a little bit more detail. So we can break down any target date fund into 4 key elements, whether it be foundationals, whether it be LifePath, whether it be a competitor. That's kind of these 4 main elements, the objective, the glide path, the asset class, and the implementation. That's where the similarities basically stop, however, because once you get under the covers, really understanding what is the investment objective that we are delivering on and how do you prove that you're delivering on that, that is critical. So our investment objective is to meet participants' needs and preferences for stable spending in retirement. I touched on this just a minute ago, but it is ensuring that we are not forcing them to alter their lifestyles at the moment that they retire or live the same lifestyle that they did prior to retirement. We are applying this to a wide range of participants, recognizing that while you as an advisor may be able to work with a client more specifically to understand their risk preferences, their spending patterns, et cetera, we are ultimately trying to create a solution that works across populations regardless of those income patterns and spending patterns. It should be applicable well across that population. And lastly, as we've said, this is very much rooted in behavioral finance, extensive academic research that allows for a very sophisticated and elegant product for your plan sponsors that you work with and ultimately for their participants. I'm not going to cover a lot more here. There's other things that we can get into in terms of asset classes we've talked about in implementation, but I think at a high level, that's the most critical point to make. So if we turn to the next slide, please. We're going to go into a bit more, as Sean had said, about total return. And it sounds like you're going to have a more in-depth session with some of the total return fund managers. So I'll touch on this at a high level. What we feel really differentiates this product is that we are delivering diverse sources of alpha within total return. We are looking for opportunity sets across a spectrum of sectors and even globally within fixed income. At the end of the day, though, these are still being delivered very close to the index with the special added ingredient of being able to move and understand interest rate environments and opportunistically look for ways to mitigate some of the dynamic nature of interest rates over time to deliver these better outcomes. And we're doing this in a relatively low risk method. So smooth outcomes, and I'll prove that to you in just a second here, and really great outcomes. So this is very much a flexible approach, as we talked about through this sector rotation, so I'm in the middle of the slide here. And the duration is relatively in line with the Barclays Agg, so you're not giving up much there. We use a very disciplined risk budget process. The portfolio managers, whether they be on my team or whether it be in the fixed income total return team, we all have access to Aladdin, which is our risk platform and provides us a great deal of insight into the risks of the portfolio, whether it be at a sector level, a bond-specific level, whether you be looking at spreads or duration. It has all kinds of metrics that allow the portfolio managers to evaluate their choices and the fund composition in a very sophisticated way. And so you're getting access to all of that with this fund. So why don't we turn ahead to the next slide, and these are really our proof points on total return. And what you can see on the top right here are, in the first line, where we rank from a Morningstar percentage standpoint. And what you can see is that in the 3 and 5 year, we're really first decile, and largely we're top quartile. 10-year, we're just a little below top quartile, but still very meaningful results. And these time frames do represent, although we've been in a 30-year bull market for bonds, but they do represent some different cycles, if you will, different concerns that have occurred within the bond market, and we've weathered those storms, if you will, quite well, and this is what you're seeing in terms of the results here, that we are outperforming very consistently, and that's exactly what we had talked about in terms of the methods that we use to deliver those consistent returns, and this is the actual proof point of that. I'm not going to spend a lot more time on that page, but in conclusion, I'll wrap up on slide, I believe, 19 in this deck. Christopher, if you don't mind moving it. Thank you. And what we wanted to show you here was just a reminder visually of the building block funds that will be in the target date strategy. So as Sean touched on, we have in the equity bucket, we have 3 main funds that we will be using to really represent a global market capitalization very explicitly. So we have large and small and mid-cap exposures. We have small-cap exposures domestically. And then internationally, we also have large, mid, and small-cap exposures as well through broadly recognized indices. And I think just to put a little bit of a plug in there for our indexing capabilities, hopefully you all realize that we're the world's largest index manager. We manage close to $3 trillion in index assets. So we are very sophisticated. We have seats on all of the major index providers' advisory boards. We are intimately involved in helping them to make real-world decisions about their index construction. And we have some of the longest history of indexing of anyone in the industry. Moving on to fixed income, we've spent a bit of time talking about total return bond fund. That is highlighted, as we said, in terms of it being the only active exposure here, but a really great way to, again, take advantage of where we feel markets are less efficient, and this can help you to manage through the interest rate environment, which is a little less certain. Moving on, we also feel it's very critical and important to include real assets. Real assets often serve the purpose of being there to differentiate the portfolios, to diversify the risk, but also to provide inflation hedging capabilities. And global real estate, commodities, and U.S. TIPS all have different inflation hedging capabilities, and we are very mindful in the way that we put them together to take advantage of each of their unique inflation hedging capabilities and incorporate them into the asset allocation at the right point in time to be mindful of whether they're a good long-term hedge, medium hedge, or short-term hedge. And then finally, we have cash is there, again, just to help with the daily flows more or less. It's not necessarily an explicit exposure, but it's something that, from time to time, as you're managing the daily flows, it becomes an important component to ensure that you are able to do that and satisfy the settlement cycle that happens within this DC marketplace. So with that, I will stop. I believe I'm turning it to Jeff. Is that right?
I think it's coming back to me, Amy.
Oh, okay. Perfect. Thank you.
I'm bookending this, I think, as the MC. So, guys, Thank you both for taking the time to take us through that. I found that really informative. I'll fess up, I've heard that before as part of our design process as we were looking for an innovative approach. And every time I hear it, it really resonates with me. This ability to take advantage of the passive indexing on the equity side and the beta, and then looking for alpha on the fixed income, which is much more complicated to index the Barclays Ag. As Amy alluded to, it's kind of an amorphous thing that changes and moves. So just in summary, before we enter Q&A, and we're going to get there in just a minute or two, I really want to reinforce the unique partnership that we have between ourselves and BlackRock and Reliance, a strategy that I think is really impactful for plan sponsors, advisors, and participants around diversification, the advantage of active on the fixed income side, and reinforcing that as participants get closer to retirement, they get more active management. And then a focus on consistency. I think consistency sometimes can be overlooked, and I think that if we get caught chasing things, chasing returns or chasing answers, we can get caught with our pants down. And I think consistency is really important to reinforce, particularly over the time horizons that many participants face. And then lastly, a glide path that's designed to withstand volatility. A glide path that I think it's really interesting how BlackRock has taken behavioral finance into account. And it's not simply a glide path that's based on asset allocation and returns and risk, but also the spending pattern over time and how people decumulate assets and how they weigh that into their mathematics and their modeling to create something that has a unique sort of investment perspective or style. So I just touch on those. And then lastly, just to reinforce some of the really tactical things, the Target Date series is priced at 22 basis points, which I think is fabulous for really large plans and also is a huge opportunity for smaller plans that may not have seen institutional pricing in the past. It's comprised of the BlackRock CTFs, so if you really think of this, it's a CIT of CITs. We're using the LifePath glide path that Amy manages, Amy and her team, and then fixed income. We're following the following indexes, and actually Amy touched on all of those and how we're investing in each of those indexes. We're looking at 10 vintages right now, 2020 through 2060. Right now we have a zero shareholder servicing fee, a zero rev share class, and we're looking at two others, a 10 basis point and a 25 basis point shareholder servicing share classes. And we can adjust those if we need more over time. Those can be added through our partner Reliance Trust. So that's the end of the prepared remarks, if you will. And again, I thank everybody from BlackRock for preparing and joining us today. I'm going to unmute the lines and open it up to Q&A. I don't have any magical way to do this I'm not fancy like a conference call operator. So wait just a second. If there's a little break in there and you have a question, please ask, and we will get the question to the right person. So unmuting now. All right, you guys, it's a free-for-all. Does anybody have any questions? No one.
Hey, Chris.
You were that comprehensive. Hey, Kevin.
So we kind of talked about this the other day. We're still thinking September time frame for the release of both of these, or as far as the
correct
and the total return.
Correct. We're aiming. So, guys, just to give a little color to that, we need to raise fairly substantial amounts of money. Fairly substantial on one hand, but when you look at the scale of the organization, not necessarily as substantial. We would like to raise $500 million in the Target Date Fund by mid-September, and or $150 million in the total return and $100 million in the Target Date Fund. I'm not going to get into the particulars there, but because a portion of the Target Date Fund has the total return CIT in it, there's advantageous funding by getting money into the Target Date Fund. So yes, we are looking at funding both of these in mid-September. We've reached out to most everybody that's on this call, and if we haven't, actually I think we have reached out to everybody on this call, and we will continue to reach out to you to discuss opportunities and explicit plan sponsors. This might really benefit them, and to begin the conversations and help prepare you folks to have the conversations with plan sponsors about this. As Bill mentioned earlier, he had a conversation with his largest client, and
This is Jeff Spiegel with BlackRock. Did we lose just Christopher? Are other folks still on?
We're here.
Yeah, I'm here.
I'm here.
Okay, well, I will, since I did get to be in the building in the front of the presentation but haven't had a chance to say anything, I guess until Christopher joins us back, I'm happy to hear any other additional questions or field any other additional questions that we can from the BlackRock side. Just to close the loop on Christopher's answer, yes, we are planning to launch the products in mid-September. Anything else that we can be helpful with to the group? Well, we have time for any additional questions, but since it doesn't seem like there are any, folks, please feel free to follow up with Christopher, and anything that we can answer on the BlackRock side, he'll plug you into either myself on the ops and the implementation, or to Sean and Amy's team in terms of any of the investment components that you have questions on. Really looking forward to the Total Return webinar for next week, and really thank everybody for the time. Have a great weekend.